Hey traders, on today's episode, I wanted to showcase some of the best interviews that I've had in the first 375 episodes of the How to Trade Stocks and Options podcast. I know that these have had a real impact on my life, and I hope that they can do the same for you. This is the How to Trade Stocks and Options podcast, brought to you by 10MinuteStockTrader.com, where we cover finance, stocks, options, entrepreneurship, education, and money. And here's your host, voted one of the top 100 people in finance, Christopher Ewell. Hey, make sure you subscribe and hit the bell so you'll be notified every time we give you more tools, tips, and tricks to help you trade faster and trade smarter every single week.
To make it as simple as possible, Steve has the SPY 200-day simple moving average end of month price crossover. Okay, so here it is, right? The market 200-day end of the month. Okay, that's it. That's the only three things you need to know. This one, the average days in the trade was 562 days. That's that giant bull market he's talking about. And the return was 437%, which is more than double the comparison results over that time period. And that's literally looking at it one day a month. If it is above or is under the 200 simple moving average. It doesn't get easier than that, people.
The first time I was on CNBC was about 2006 maybe, or 2007. A friend of mine, Herb Greenberg, who used to be on CNBC all the time. I don't know what he's doing now. I got to call him and find out. I had said hey, I was kind of stupid at the time. I thought, I could be on CNBC. I had no idea what that meant. And so anyway, he was able to kind of get me hooked up with some producer. And he said, he called this lady up, I forget her name. And he said, hey, a good friend of mine, Dan Fitzpatrick, you got to have him on CNBC. He's great on television. And so he called me back, and actually I think she called me first and said, it was 5 minutes after I talked to him, and they booked me on the show. Going what the heck?
Wow.
Yeah, and then he said, so then Herb calls me back and he goes, you've never been on TV before, have you? And I'm thinking, well, I did sing with John Fogerty one time. So I said, nah, not really. And he said, okay, here's the deal. Have an opinion. He goes, have an opinion. It doesn't matter if it turns out to be right or wrong, but don't go on there and say, I don't know. Have an opinion, because that's what's important. And so I did. Well, okay, fine. Enough war stories. And I was on with Peter Schiff, who anybody who knows Peter Schiff, he's the most bearish guy around. He thinks 12 years is too long for this earth to survive. I love Peter. He's a great guy. But anyway, the bottom line is, though, that was way back when. After all this time, I could go on CNBC whenever I want. For the most part, I know enough people to where I say, hey, I got something to say. And I'll go on. But for the most part, Chris, I don't know. I don't have an opinion.
Yeah.
I don't. Because I've been doing this long enough to know what's not knowable. And that's why sometimes with financial television or with things that people write, the way they write, I'm going dude, I've been doing this since 1996. There's no possible way that you can know what you're telling these poor people who don't know any better, what you know. You don't know that. And it as you can see, it drives me crazy, because we have an obligation. I assume that somebody who's listening to me, whether it's here or on Stock or Option Market Mentor, I assume that they don't know as much as I do, and so I take my responsibility seriously. Now, the cool thing is, when you're actually listening to somebody else, you actually want to make the opposite assumption and say, I don't know who I'm talking to, but let me see if I can learn something from this guy. and that's the way you get better in life. But I look at things now so much differently than I did 3, 4, 5 years ago. For me now, it's risk management. It's like, okay, I don't know which way the stock's going to go, but I do know charts, and I know how charts work. I know that I call it a power cycle. This is the way I look at charts. There's four groups of market participants. There's buyers. Boom, you bought. You were in that group for a split second. Now you're a potential seller. That's it. So you just went from the ultimate bull, boom, I'm in, to now, at some point, a bear. You've gone from support to resistance. You just don't know when. And then those are potential sellers. And then there's sellers. Those happen just in an instant. And then there are what? Potential buyers. So it's like you're exchanging stock for cash or cash for stock. And that's instantaneous. The rest of the time, you are potential energy. You're built up energy. And so when I look at charts in that way, then it makes sense to me, because I see, like, okay, the longer a chart is stretched out, like if you look, I don't know if this is interesting to you or not, but it is to me. It's fascinating.
No, I'm really into it.
The longer a chart is stretched out, 6 months ago, or 6 months ago, a year ago or something, like, do you really, and the stock's just gone down. Do you really think that anybody who bought 6 months ago is still going to be holding that stock, and they're going to sell it when it gets back to their buying point? No, they've had 6 months to correct that mistake.
Right.
They're done. They're out. Doesn't even matter. Whereas you're trading a stock on Monday and you buy like right at the high, and then the stock pulls back a few days, and then it starts to come, and you're going like, crap, I know I shouldn't have bought that stock. Dan told me not to be doing that, but I did it anyway because I got the can't help it, and I just had to do it. So then the stock goes down and you're feeling like an idiot. And then the stock comes up on Thursday or maybe even Friday to your buy point. What are you going to do? You're going to correct that mistake, and you're going to say, I think I'll just undo this. It hasn't cost me any money. Sell. Your resistance. If you bought 6 months ago, you're not resistance. If you bought yesterday or the day before, you're resistance. If you were thinking about buying yesterday, but you didn't, and then the stock pulls back and you get an opportunity to buy at the same price, you're going to do it. You're support. If you were thinking about buying a stock 6 months ago, and you didn't, and it pulls back to there now, you're not support, because you've moved on down the road. You're not even thinking about that stock anymore. So those are just the kind of ways that I look at charts. And maybe it sounds a little convoluted, but to me it makes a heck of a lot more sense than just looking at these lines and boxes, wiggles, and all that.
So how do you tell if the moving averages are crossing? One example would be XRT. If the audience wants to go look that up, XRT right now has the 10 and the 50 and the 20. It's weird. They're all like in a straight line on top of each other, and they're kind of like playing back and forth on either side of the moving averages. So no trend has really been shown from that. But how do you decide when it is going to start a trend versus just chopping back and forth?
Well, you can use it either discretionarily. You can see, did the crossover happen, at a good lower RSI? Like, is the market not overbought? Did the crossover happen in a better risk reward ratio if it happens when you're oversold and not too overbought? And also, you can do mechanical. You just take all the crossovers, and eventually you have the big winner, and you manage the trade. If it keeps going higher, you hold it. If it pulls back under one of the key moving average, you can exit. So really, you can enter all the signals and then manage each trade reacting to what is happening to maximize the win.
Okay.
The really whole point, like the GLD, if you look back at the GLD, you had a bunch of small losses with the 5-day, 20-day crossovers where they didn't work out. So you had like a small loss, and then all of a sudden you had an explosive trend if you use them mechanically. So that's the thing. You can use these signals as a mechanical. You're just going to take the trade regardless and see what happens and manage to maximize and wins and minimize losses. Or you can use discretionary, filters like, and I do use a 70 RSI or the how is there a range before the cross? If there's a range before the cross, it can increase your odds of a trend. So there are ways to filter for more dynamics in your systems. The moving average book really wanted to give you just the framework to see, quantified data for how trends can be captured.
Yeah, that makes a lot of sense. And to Steve's point, using these systems, man, this is one of the most fascinating points that I took away. The win rate could be low. In fact, I was just scrolling through here, looking through these. I only saw 1 or 2 or 3 that actually had a win rate greater than 50%. But what Steve is saying is that if you use this approach, getting in and getting out with the crossovers and everything, it may cross over and then it may cross back the other way, and then that's your exit signal. And then it may cross up again and you get long and then cross back the other way. And then maybe on the 3rd or 5th or 12th time, it crosses over and then it takes off. And you've got to have your portfolio prepared and ready for that. So you may have 6 or 8 losses in a row of this strategy before the 9th one potentially comes into play and it's off like a rocket.
I think Paul Tudor Jones really quantified the risk reward ratio. One of his quotes, he actually says, he can have a 1 for 5 risk to reward ratio and only be right 20% of the time and still be profitable. And he said he could be an idiot still make money. And Paul Tudor Jones, one of the greatest traders of our generation. I don't think he's had a losing year in 20 something years, which is unheard of. But so if you had a 1 to 5 risk to reward ratio, so if you lost $100, lost $100, lost $100, lost $100, and made 500 on your 5th trade, you've lost 400, made 500, and you're still up 100. With a 20% win rate with a 5 to 1 risk reward ratio.
Yeah, and that makes so much sense. And this is the kind of stuff I wish I'd known sooner. Instead of the buying something and hold and hope or whatever they call it, right? Yeah. Whereas there's no mathematical quantitative approach to say, hey, things are going your way when you're staring at the face of several losers there. So yeah, really, really interesting and very useful to me as I'm reading through this, and certainly would be useful to all the audience members there.
Yes, the principles are really powerful. It's the principles to create something you are psychologically comfortable with doing, whatever that may be, in whatever market and whatever time frame. Really, it's the principles that are powerful. Most people who didn't have the patience to sit and have a 10-day, 50-day crossover and hold it for a few weeks like I do, that can be frustrating for some people. And other people might, have an end-of-month signal. People love the SPY into 200-day end of month. If it's above it, you stay long. If it's below it, you go back to cash. Some people that used to be buying holders think that's a really active trading system. So you have to have something that fits your own belief system and you believe in, you have faith in, that you can do. Whatever you can actually execute is what really matters.
Yeah, and you just mentioned one of the questions I had was this end of month signal. This is the first time I've heard of that. Now, to me, I'm thinking, okay, I've got basically a 3% of my month would be devoted to potentially making a trade or not making a trade, essentially either stay in or get out. But you're only looking at it 1 day a month. And surprisingly, that did well. Like that was the biggest shock to me, is that you could look on just the end of the month day to determine in or out. But the result on that was really good.
I think the power of that is, if you're in a bull market, you're not doing anything. Just let the bull market run. And we've had and all the data is from the entire 21st century. This is all from January, whatever the first day of trading was, January 3rd of 2000, all the way until the book was published. This is 21st century trading with all the high frequency traders and the internet and the cheap brokers and all the stuff people complain about. These back tests were done 21st century, so people can't say this is stuff that doesn't work now. So but like you said, it's the bull market. That's where you make the money. If you just bought Amazon and you bought Amazon and you traded it with moving averages, you made a killing. I mean, if you bought the SPY, used some leverage and held it for uptrends, you're making a lot of money. You don't have to go down. You don't need 20 screens and watch every tick and spend 9 hours in front of the screens every day to make money in the stock market. That's not what the vast majority of the millionaires and billionaires did to make their money.
Here on the How to Trade Stocks and Options podcast, we give you the tools, tips, and tricks to help you trade faster and trade smarter. And I think the smartest thing you could do is open a new brokerage account with Tastyworks. Tastyworks is a brokerage platform that I use and I recommend. The commission structure is absolutely unbeatable at $1 per leg total. Now, if you sign up for a free Tastyworks account using the code 10MINUTE, that's 10MINUTE, I'll give you $150 in free 10-Minute Trader exclusive bonuses from 10MinuteStockTrader.com just for opening a free account at Tastyworks. Remember to use the code 10MINUTE, that's 10MINUTE, when signing up for your new Tastyworks account today.
Right. And to make it as simple as possible, Steve has the SPY 200-day simple moving average end of month price crossover. Okay, so here it is, right? The market 200-day end of the month. Okay, that's it. That's the only three things you need to know. So whenever you're looking at your trends there, is this something that you're doing manually, or do you have an alert set up that, maybe on your platform that says, it flashes out and it says, hey, Mark, this is now hit your trend criteria. This is now something you might want to be looking at. Is that how do you do that?
Well, that's just the very initial criteria. That's what I call a qualifier. So in order to qualify as something that I'm going to buy, generally, it has to be in an uptrend. There are a few caveats to that, but generally speaking, you're going to be in what I call a stage 2 uptrend. As a matter of fact, for those of you who subscribe to MarketSmith, you might know this already, and maybe you don't. And for those of you that have not subscribed to MarketSmith, you probably should, because it's a great place not only to get all this information with regard to fundamentals, earnings, sales, your relative strength, all that, but they've added my trend templates in there, so you can actually screen based on my trend templates and use it as your qualifier, and then you can build screens on top of that trend template. So you use my trend template as your qualifier, and you won't see stocks that are in downtrends. You'll only see the stocks that are in uptrends that you should be putting your eye on.
Wow, that is too cool. I'm gonna have to go check that out right away. Thanks for sharing that, Mark.
It is really cool. They've done it this last year or so, and it's a pretty neat tool there.
Well, I definitely recommend for everybody out there to go check out MarketSmith then. So the next question I had for you, Mark, was I actually had volume completely turned off on my charts. I never even looked at it, not even once, because to me I never realized it mattered. But, in this book here, you really talk about how that's a telltale sign of institutions that are getting in and helping drive these tens of thousands of % change. When you're looking at it, is it your objective to try and, emulate the institutions? You see these big volume spikes. At least this is what I was getting across here, is that you're seeing these big volume spikes. You're seeing the stage 2 trends. To you, that's a clear indicator that there's institutions buying this and they're moving in with big size and big money. And is that your goal, is to try and emulate the big institutions as closely as you can?
Okay, so you have two questions. One's on volume and the other one is on whether emulating institutions. So let's start with volume. Volume is the next most important thing next to price, and price should always be looked at with volume. So that's going to tell you pretty much the acceleration or the power behind the price. So that's extremely important. Price and volume is highly weighted in the work that I do. And then, of course, the objective is, as a smaller investor, I mean, even if you had a $20 million or a $50 million account, which would be a very big individual investor, of course, you're not a big investor, relatively speaking, on Wall Street compared to the institutions, the hedge funds and the mutual funds and the pension funds that really move stocks and move the market. So think of it as you're a speedboat, and these other institutions are like cruise ships, where you could just whip around very quickly and you could turn your boat around on a dime, and they have to make these big turns. It takes a long time. So the key is to take advantage and of the institutions. If you know what the institutions are looking for, you could get in there and take advantage of their big volume coming in and moving the price. And that's the whole idea. And that's where, when, just to give you a quick history, when I first went on Wall Street and I first made my name with the U.S. Investing Championship, and I made all those returns that everybody heard about, and of course Stock Market Wizard. I was a pro to the pros. I advised people like George Soros's Soros Management, some of the biggest hedge funds in the world, mutual funds, and you couldn't even get my research unless you were an institution. No individuals could get my research. That was my career on Wall Street. And then I retired. When I came and wrote this book, McGraw-Hill came to me and asked me to write a book. I decided to enlighten the individual so they know the things that I would tell the institutions, and also to know how to get in there and to move quickly and take advantage of their first mover advantage, or if you will, their speed and agility, to be able to take advantage of those institutions. And that's how this whole thing transpired with the book.
Wow, that's incredible. That makes this book here, I think it was around $20, potentially the biggest bargain in human history.
Well, there's a lot of books that are incredible, unbelievable bargains. Most books that are written by successful people that tell either their life story or their methods are worth far more than the price that you pay for that, whether it's $30, $100. Books are relatively cheap for what you're getting. I have right now, sitting in my office, I have about 4,000 books behind me in my library. I am a bookaholic. So, and that's one of the reasons why I write books, is because books have been so pivotal in my life.
There was one article we saw where somebody was saying, hey, I was going to buy this stock, right? Can I return it if I don't like it, if it doesn't do what I want it to do?
I think I saw that too.
Yeah, and these are the things that we're kind of like, those of us who've been in for a long time have been like, wow, this is not a simple thing. We want to make sure that people know what's going on, because when I started, I definitely lost money. I lost a lot of money, and I even lost money because I pushed the wrong button. And so I tell people, when you first get into this, don't use real cash, because your psychology is tied to that cash, and you're going to have a real issue when it starts fluctuating. So make sure you kind of figure out what you're doing before you add cash to it, because then also you need to make sure that you know your trading platform, because you'll press the wrong button just like I did when I was starting, and you might lose a few thousand.
Dude, I did that last week. I'm not joking. I was on vacation and on my iPad, and I'm trying to put in some trailing stop orders. And rather than like a let's say something's trading at 200, I was trying to put it in at like 195, trailing stop order, and I put it in a market order and like instantly filled, and I'm like, this is not what I wanted to do. Yeah. I was pretty irritated about that. But yeah, it happens.
That's the problem with the tablets and touchscreens. Sometimes you might bump the screen somewhere, or you got a lot of options. You don't know what you're trying to fill in here. You got to make sure you know your trading platform, because I tell you, if you guys are trading options and you're going to be doing straddles or strangles or call debit spreads and all these kind of fancy things, you need to make sure you know what that looks like on your trading platform and how to get out of them. That's the biggest thing. Is, well, if it starts to go against you and something's wrong, how do you get out of it? What do you need to do? And that's where it comes that you need to make sure you understand your platform.
Oh, without a doubt. And there's so many variables when you come to options, right? It can be awesome, but it can also be horrible at the same time. And you're a stock guy. So why do you stick with stock over options?
For exactly that reason. I just don't want to deal with the complexity of options. I know that there are a lot of beautiful things about it. Of course, the leverage is great when it works your way, but then the leverage is also pretty bad when it doesn't. And I don't know, I've just never had a good time with the extra moving parts and components. And really, when I started learning how to trade the market, I just said, look, if I can just understand how price is going to move, how to read the charts, where it's going to go, then, later I can trade options. I can do whatever I need to do then. But I'm just going to stick with the simple and the linear. For me, that's the big deal, that it's linear. The dollars move like $1 up, $1 down. I don't have to worry about theta. I don't have to worry about implied volatility. I don't have to worry about any of that kind of stuff. And so it just makes it a whole lot easier for me to say, hey, one tick up, $1 up, and I just go with that. Now, that being said, I have a lot of people who follow me who trade options, and they're very sophisticated and they're smart. They know how to trade. They know how to trade options. But what they want to do, because they maybe have a full-time job, or maybe they haven't had all the years of experience that I had, they want me to do the legwork of scouring the market, because that's what I love to do, and actually bringing these good trades to them, good setups, and say, hey, this is the setup that I see based on my Moxie method, and you can go take it and you can go apply any kind of fancy trade you want to it, with the idea that this is going to happen this direction and what I believe it's going to do.
That makes sense. So when people want to learn about the 100K a day trade, 100K in 1 day trade, then go to the webinar. So tell me everything that's in the webinar that you cover on this.
Yeah, so simplertrading.com/single for the $100,000 in a single day. You guys go check it out there. We got a replay. I'm going to be doing another one coming up next week. And then I've got a big class that I have teaching about everything that has changed in this market. That's going to be on August 8th. So be sure to sign up and check that out. I have my method. I've been using this method for years. I have a big following with it. I think it really resonates with people because I'm more of an engineer. I kind of think, nuts and bolts, black and white. And that's how I've kind of dissected the market along with the Moxie indicator and my Moxie method. But this market has now changed since the COVID crash, since the Fed is pumping in billions and trillions of dollars. And since the stimulus money is making its way into the stock market through individual people, through individual traders and all these new traders, we also have zero commission. So you got to think about, we have all these, it doesn't cost any money to trade anymore. And so it doesn't, people can come in and out of the market willy-nilly and not have to worry about any cost. So we get some kind of weird different vibes going on in the market. And then we have all this QE stimulus, and it just has put a different behavior in the market. And the market is also much quicker now. I used to love the daily and hourly chart. Now I'm having to step down to lower time frames. And these are the things that I want to be able to show people, say, hey, even me as a professional who've been doing this for a long time, I suddenly had to look at this new market and say, wow, what is going on and what do I need to do to capture this stuff? And so it took me a little bit of kind of figuring out. I had to write down some new rules and kind of adjust what I was doing, but I got on top of it quickly. I adapted, and it's now turned out to be one of the best seasons I've ever had.
Well, there you go. That's a smart way to play it, TG. Just being flexible with the market, because
Absolutely.
what may work today may not work tomorrow, and being smart enough to identify that is really key, right? You're not going to be left behind when I was talking to Jack last week, and he had such a great point. He was saying, the new safety trade is no longer bonds, or it seems like gold at the moment, but no longer gold or bonds, but it's Netflix and Apple and Amazon, right? And I was like, I think you've got a really good point there, because like as a millennial, people don't care about bonds, people don't care about gold or shiny coins, things like that, but they do love using their Netflix. And I know my wife has already ordered 8 things on Amazon today. So it seems like those could be the new safety trades. And I did like the idea of that. It made a lot of sense to me. And then I think about my father-in-law. He was a gold bug. Oh my gosh, he was a gold bug. He was all about, I'm not going to invest in a bank. I'm not going to do 401k. He was all about gold coins. So he was the opposite of that. So like I say, it's the difference between your grandfather's methodology and the new school Robinhood traders, I guess you could say that. And I don't mean that in a derogatory term. It's just
think about
people accessing
think about what our parents and our grandparents were dealing with. They didn't have the internet. They didn't have tech companies. What they knew were bonds, and they had gold. And we used to be on the gold standard, and we used to have hard cash related to gold. And everything has kind of changed. So our generation doesn't really think about bonds. Do you think parents or grandparents still give saving bonds to their kids? I mean, I got one when I was a kid, but I'm a little bit on the higher end of the millennial spectrum. And then you think about, well, gold. I mean, they don't know anything about gold necessarily. Does that really resonate? Maybe right now we did take the gold trade, but they know Netflix. They use these things. They're companies they're familiar with. It's like back when Coca-Cola was the company you go invested in. It's back when GE was the company you invested in, because those are the companies that you loved, and you used. Nowadays, everybody knows Amazon and Netflix and Apple, and they love them and they use them. So that's kind of the new currency for this new generation.
Now, has natural gas been depressed like oil has been lately, or is it just moving its own way?
It has been. It's depressed. It's at maybe even all-time lows, to be honest. I mean,
wow.
I think it might have just came off them. You really never hear about it, but it's terrible. It's been under pressure for years. It just keeps going lower and lower and lower. And I mean, it's at a point now where it looks like it's ready for a really significant move. We got two of these moves last year. Both of them are about 40% to the upside. Exact same basing formation pattern form, which is why I'm excited. I mean, this is round 3 on it. So it's got a lot of upside. It's way overdone to the downside. I mean, it's just an ultimate bear market. And on a swing trading standpoint, on a daily chart, I mean, this is the first real good setup in months and months and months, and it's just been going lower and lower. So this could have a lot of power.
So you're not going to sell any naked calls on that, are you? Like
No.
that fund that blew out last year? Man, I watched a video of him apologizing, and I'm like, oh, wow, how could you? Yeah, that scares me. Like when I trade options, everything's a spread. I never trade naked just because that's my personality. Like we were talking about earlier, finding trades that fit your personality. And you know, when you have that unlimited risk, it's just like there is no good reason to do that. When you could see, like you were talking about there, potentially a huge spike in volatility coming, and then oof. So now with natural gas, looking at coupled handle. In fact, when you were describing that, I don't know if the audience was really paying attention. I definitely recommend re-listening to this podcast because what Chris was quoting there, it was almost like he's taken a textbook on how to trade, like maybe Bill O'Neill's How to Make Money in Stocks or something like that. And he's like, this is how you do it. You look for the cup with handles. You look for volatility contraction patterns, as Mark Minervini would describe it. And then you get the bump to the upside, and then it goes from there. So, yeah, I was really digging that right there because I definitely knew exactly what you were talking about. So now with oil. I heard that it's better than free at this point. Is that still the case?
I know it's confusing. I mean, oil isn't worthless. It's less than worthless. I mean, it was just crazy what we saw in the market, and it really blew my mind. I mean, I was watching it. Oil hit $11 a barrel on my continuous contract chart, and it hit our target. We were expecting it to hit that level this week. And then, so I started doing a video, a screen share for my clients, and I'm sending it out. I'm like, you guys got to see this. It's hitting our target. It's in free fall mode. We just have to let it wash out. And, you know, this is a major multi-year low. And then I see it, and I send it all out to the members. And then I look back at the chart. I'm like, what the heck? It's at $3. It's at $1. It's at 16 cents. And then it goes negative. And I'm like, I don't know if my data's right. So like I panicked and I wrote everybody back. I'm like, ignore the video, that analysis. I don't know what oil's doing anymore. I think my data is off. So step back. We never traded it. It was never a trade. It was just, you got to look at this price action type of thing. I don't want to trade anything doing this type of thing, right? But I mean, I had to retract everything because I didn't even know futures could go negative. I think a lot of people didn't know that. And I still don't really know what it means for it to expire minus 36 or 37. Does that mean if you just take 1,000 barrels off somebody, they're going to pay you $37,000 because it's or whatever that is, or 30? I mean, I don't get it. So when this was the learning lesson for members this week was when you don't know what the heck's going on, you got to just step back.
Yes, you don't want to be involved.
And you've got to just step away from it, because my natural instinct was I call up my friend. I go, oh my gosh, what do we do? How do we make money on this? And we've both been trading. He's been trading for 35 years. I'm 25 years. We're looking around. We're like, we don't know really what's happening. There is no safe way to trade it because the USO and the oil ETFs have a problem with contango, just like natural gas. So getting into those is actually really deadly, because even if oil goes up the next day, these ETFs can actually go down. And that's what happened. I told members, I said, don't touch an oil ETF. Everyone is piling in today. I can see it. Don't trade it, because tomorrow it could open down like 50 or 90%, even if oil doesn't go higher or rallies. And it did. Like USO spiked down 40% the next day, even though crude was up 20%. And it's just, that's how deadly trading commodities are with ETFs can be. And I mean, my natural instinct was, how do we make money on this?
Yeah.
And when two of us couldn't figure it out, we're like, holy crap, we better tell members, like, we don't even know how to do it, so don't even touch it, guys.
Yeah, absolutely. I couldn't agree with you any more than that. I mean, my first thought was, I don't even know what I was doing. I happened to have my phone open, and it was on Twitter, and it was like, oil is about to go to negative. And I was like, what? And so I keep scrolling, and I'm like, oil's -3, oil's -6, oil's -30. It's like, what? How is this possible?
Yeah.
So yeah, what interesting times do we live in? Like, my wife could not care less about financial markets, and I was like, you will not believe what happened today.
Yeah, I know. Usually people always call me when something happens, and when crude oil broke zero, actually when it hit 11, I started calling people. When it broke zero, I'm calling even more people going like, what is going on here? Like, what data do you have? And I mean, it's so weird. Like, usually I don't have to call anyone to get insight on the markets, but when I'm calling people, there's a problem.
Yeah, for sure.
It's like, holy geez.
Well, Chris, this has been a great conversation. I've really enjoyed this. And like I said earlier, I do hope the audience goes back and listens to the wisdom that Chris has here. I mean, within like a 20-minute conversation, he dropped some major knowledge bombs on you. So I have really appreciated that, Chris. Thank you so much for going into all the detail. This has been a very great conversation.
Yeah, well, I mean, I love technical analysis. I mean, I'm a visual guy. And, I've read all the Bibles, like the John Murphy technical analysis and all those, 1,500-page books. So I know all that stuff. And it's amazing because you see it happen on the charts on every time frame. Could be the 1-minute chart, could be the weekly chart or monthly. And the patterns just unfold. And once you understand the intermarket analysis, when something's doing something out of the norm, you can usually find an opportunity, what it means, and find a pattern somewhere to trade it. And I mean, technical analysis is great. You don't have to rely on news or earnings and all that stuff. So if you want some good technical analysis on something, I mean, I love to talk it because it's just always interesting. And
yeah, I've written a short guide on how you can use the triple stock profit system. It's the secret weapon every investor needs right now to change your financial future, and you can get it for free by visiting triplestockprofits.com or in the links below. Also, if you want to join a community of traders just like you can get free access to the elite membership that has even more resources to help you trade faster and trade smarter. Hey, if you like this video, let me know by leaving me a like below, and then subscribe and share it with somebody you think could use it as well. Be sure to comment below with your biggest takeaway from this episode and any suggestions you have for future episodes. And finally, make sure you watch these other videos to help you trade faster and trade smarter, and I'll see you on the next episode.